Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month nickel, zinc and tin. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
LME 3-month nickel. In late January, we saw the market move from a January-based ascending wedge pattern straight into another similar setup. Originally, it was a February-based ascending triangle or ascending wedge pattern that morphed into what we have now, a shallow, bright red, broken January to mid-April bull channel. Now February, March and now April made this bright red bull channel, but they also made another pattern, an earlier pattern, also broken on the upside. A late February to early April dark blue descending expanding wedge pattern, highlighted in bright red on my chart. This one had required number of touches each side and highlighted in dark blue on my chart. This one had the required number of touches each side, and with the significant break higher, I decided 3 weeks ago to lay out some targets for the move up. Thus, we had a primary target X, which is up in the 18835 area, close to the August 2019 high at 18850, and a secondary high to reach target X1 is up in the 19135 area, close to the highs earlier of this year. Both these targets have been reached. The origin of this move higher can easily be seen as at the turn of March into April, prices became squeezed between the dark blue upper trend line overhead, which had previously been helped by the green short medium moving average, currently at 17,740, and from below by the rising bright red lower bull channel line. Thus, it was not a surprise that we saw a move higher, as something had to give way, and this time it was the turn of the dark blue upper trend line and green short medium moving average. For a while in mid-April, prices became held down by the bright red upper bull channel line, and also on a closing basis by the July 22 low, but late 2 weeks ago the market broke higher. Now, it seemed that there was only the September 22 low overhead, up at 20.045, to slow or halt prices, but we stopped short of that. So I checked back and we do have an April 24 high closer to it at 19,775. Even this had since been superseded, and in truth I had doubts as prices stopped short of it, too short of it to be, I think, serious. I suspect it may be credited in part at least to the middle tine, so far not highlighted, as I wish to see how it performed. The middle tine of the currently at 19,395 of the December 25 to March 26 bullish shift pitchfork, acting as an attractor. We shall see if this remains true in the next few days. It now nevertheless raises some interesting possible targets for this break above the bright red bull channel, of a primary target X2 up in the 19,745 area, so not too far above where we are now, and the current hesitation and secondary harder to reach target X3 up in the 20,485 area. I'll be interested to see how these now work, especially if we resurrect the idea of the whole December 2025 today action as a bullish halfway hesitation pattern. LME 3-month zinc. We are still here, as I said last week, with one big old pattern, and it is a big one, and a pattern about which I've spoken about before, and also one newer, smaller pattern. The big old pattern is the bright red May 23 to April 25 bullish Andrews pitchfork, especially the middle tine, which is currently at 34.36, which started being tested late 3 weeks ago, causing some hesitation around it before moving back down at the start of last week. In moving higher in the first place, prices overcame a pair of resistances that became supports and are now seemingly splitting up, with one becoming a support, again the 50% Fibonacci line, the March 20 to March 22 move at 33.29, and the other becoming a resistance again, and that's the 50% Fibonacci line of the April 22 to May 23 move at 33.77. Then we have the second newer pattern, the April 25 to March 26 bullish Andrews pitchfork, with the market in between the dark blue lower time below, currently at 31.23, and the dark blue middle time above, currently at 34.64. Indeed, this dark blue now overhead middle time seems to have been part of the reason for the hesitancy we've seen 2 to 3 weeks ago. So what have we on the downside that may slow or even halt the decline? Well, apart from the 50% Fibonacci line at 33.29, we have a possible congestion zone from about the October 24 high at 32.84 up to the December 22 high at 33.39. Now there are various levels in between, but I'd rather rely on a congestion seen between these two levels over late January through to early March. Meanwhile, on the upside, well, apart from the hesitancy we seem to be seen below, to be honest, there wasn't much apart from the January 23 high at 35.12, and that is it, between where we are now and the high made back in January at 35.75, and the February 2018 high, a little higher at 35.95, except we now have, once again, a 50% Fibonacci line at 33.78 plus 2 middle tines, one bright red and one dark blue. LME 3-month tin. In the big picture, the market here since December last year is moving in between the bright red middle time below, currently 41.185, and the bright red upper time above, currently at 58.605. And that's the one big old pattern, still even now, dominating this market. And that is the bright red, shallow, big old 2020 to 2022 bullish shift pitchfork. A pitchfork that is still in operation 4 years after it was created. In the meantime, in the time actually of its operation, we have seen the creation of a lopsided January to February head and shoulders top that failed. A double bottom over February, that worked, and a double top between January to March, that also failed, and most recently a dark blue mid-March to late April bull channel from which prices have late 2 weeks ago just exited out on the downside. Indeed, I said 3 weeks, and I quote, I would look closely at the 2022 high at 51.005. This may not look that great as congestion at a first glance, but it was instrumental in making the center of the double bottom in mid-February, and would thus not ignore it. However, we also have some Fibonacci levels for the whole of the 2026 move at 47.595, 49.775, and 51.960. And that's the end of the quote. Early last week, prices closed back down below the 50% Fibonacci line at 49.775 and went on lower to test the green short medium moving average below, currently at 48.485, but immediately flinched and pulled back up towards the 50% Fibonacci line, such that we seem right now to be caught between the green short medium moving average below and the recent 50% Fibonacci line above, with possible outlying support being reinforced by the rising mauve medium moving average, currently 47.765. This sort of action led me last week to lay out some potential targets below for the breakdown through the dark blue bull channel. And so primary target X is down in the 48.200 zone, so not too far, with a secondary harder to reach target X1 not too far lower down in the 47.250 zone, and with a tertiary much harder to reach target X2 down in the 43.235 zone. There is an argument for saying last Wednesday's low was close enough to the zone of target X to say it's been achieved. And I can see the point, but I am not satisfied, not yet at least, with such a technicality. We need to see if these downside targets are worth the effort in defining them, and I am not so sure about it now.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.